S&P 500 futures rose in overnight trading on Wednesday, supported by a jump in Nvidia shares after the chip giant posted record revenues and issued upbeat guidance. The S&P 500 climbed 0.7%. The Nasdaq was also up more than 1%, but Nvidia shares really surprised the markets and rose 9% in after-hours trading. Now, the company said its total revenue rose a jaw-dropping 265% from a year ago, driven mainly by its expanding artificial intelligence business. Nvidia's data center business logged $18.4 billion in fourth quarter sales, up 409% from the same period in the previous year. The segment includes the company's H100 graphics cards that are widely used to power generative artificial intelligence apps such as OpenAI's ChatGPT. Nvidia is now the fifth largest company in the US, that's by market capitalization, and it's forecasting another stellar revenue gain for the current quarter. This is expected to further boost confidence in the AI sector as a whole and in the chip maker market. For more on this now, let's bring in Jamil Ahmad. He is chief analyst at online trading brokerage GTC. Thank you for being with us, Jamil. So Nvidia is the current market leader for supplying computer chips used for AI research and products. I would ask you if it's a buy or a sell, really, but also, do you really expect it to continue growing this much in the next few quarters?
Ludovica, you used the correct word in your intro there, jaw-dropping, because that is the exact way we can explain the exponential rise of Nvidia, not just in this year, where it's up more than 40%, but if you include the rally of 2023, where many everyday investors would not have even been aware of this asset, but it did rise by more than 230% last year as well. In terms of is a buy or a sell, it's clear what the investor behavior is right now, and everybody's all in on AI, and they're all in on this stock. If you also look at the revenues, this was a very highly anticipated release, perhaps the dark horse and the most highly anticipated release of the whole earnings season, but it did smash expectations. We see another 9% rally, and it's clear that when you're in the same pedestal now, so like Apple, Microsoft, Alphabet as the most valuable companies in the world, you can have more attention on it, but so far it's able to handle the hype.
Interesting. What are the current risks in the current market environment, and not just for the tech sector, but for US equities as a whole? I mean, we saw the FOMC releasing its minutes yesterday. What are they telling us?
Completely correct. I think, again, the first question as well handles this question, because you asked whether this can continue. And one thing we've spoken about now for global markets for a number of years is the potential bubble. Of course, when you have an asset such as Nvidia that's risen so much, yes, there is a bubble there, but the bubble continues and it's like a hot air balloon that hasn't yet popped. In terms of global market risk, the FOMC minutes with the Federal Reserve, investors have priced in so much good news into the global markets based on lower interest rate expectations, but clearly lower interest rates are not coming as soon as those hoped. And you just have to look at the core economic data that's coming out. Last week, we've had Japan enter a technical recession, as well as the United Kingdom. It's clear that the world economy is not in a good shape at all, but global markets continue to rally. So I would point out that's the risk, that markets are completely disconnected from reality. And at some point, we should have a correction.
And that's true. The Nasdaq could see a rebound from its three-day losing streak on Thursday. Regardless of that, do you think valuations right now are stretched? I mean, you said there's a potential for a boom. Do you think the price-earning ratios then are too stretched and they would have to somewhat normalize at some point?
Very much overweight. It's like going on a diet. Yes, we're losing a few kilograms, but if you look at the market overall, it still looks like the diet needs to continue for much longer. Generally speaking, what has helped the global market environment, despite the pessimism that's creeping in now when it comes to Federal Reserve, US interest rate expectations and central bank policy as a whole, is that for the most account, we've actually had a very strong earnings season in the United States. But then again, I would say there's a different pedestal here, because the United States economy continues to handle the heat, whether it's inflation, whether it's broad economic issues. That's the same for core economic data and the same for corporates. But if you look away from the US, you see very underwhelming and distressing data, European Union, United Kingdom, and so forth. So I would say that is really what we have to worry about heading further into 2024, because at the moment, it's pretty much the United States that are handling everything on our shoulders, at least when it comes to the good news for macro and corporate data.
Fascinating insights. Thank you very much, Jamil Ahmad, for being with us.